So DMART has come out with their latest results with sales and profits at almost an all-time high with regards to the last 8 quarters. It is definitely a very strong showing from DMART, which showcases the urban demand right now in the market. So as a stock, if you are an investor, we know that this is a very high P2E stock. But if you are creating a portfolio that has higher chance to grow, does it merit to include DMART in your portfolio? Let's ask Mr. Prasad and get his view.
Yes, a positive affirmative yes, because there are two things about this company. Number one, it is into the kind of supplying the commodities across the distribution channel. This company does not produce anything on its own. Having said that, having set up several outlets in the country already, for them it is like a cakewalk to set up more stores at more locations, provided there is a buying capacity by the individuals. Fortunately, in India, recent changes suggest that the buying capacity of urban population has not gone down so badly like it happened for rural poor. Fortunately for this company, this is not catering to the rural segment at all. So having said that, different setting up of a new stores is easy, and then all the protocol is already in place. They will have standard operating procedures to increase the count of the stores. But still, if you look at the numbers, there is one problematic sign here, though it is not majorly negative. If you look at the profit margins, which used to be around 6% in 2022, has come down to 5%. That means when the people start spending a little less or a little more considerate on their spending habits, the margins will shrink because they have to offer more and more schemes to move the stock away from their stores. And having said that, now in the last quarter, that is 2024 March, if you see, it was 2,535 crores profit. Now it is 2,650. But if you look at it for the last 4 years, turnover used to be 22,000 crores, has come to 53,000 crores. That means it is almost like 2.5 times. Whereas the profit, if you see, from 900 crores or less than 900, it came up to 2,700. That means the profit has overtaken. That is what we always say. Once you set up a business model and expand, and your expansion does not have any kind of competition or kind of risk factors associated with that, then net profit margin should be better than what it was, because economies of scale come into the place. Having got more stores in your hand, you will have purchasing power, demanding power. You will demand a better terms. That is why this company is able to sustain and expand the bottom line. Having considered the current situation, market price is 5,083, whereas its expected price is 6,581. The gap is almost like 30%. Almost like 30%. It satisfied growth. It also satisfied 30% gap. So it should be bought if you don't have retail stocks in your portfolio. If your retail stocks are less than 20% of your portfolio, still you can add this company into your portfolio.